qualitatively supported. And by qualitative, I mean that there does seem to be a relationship between beta and expected return. Empirical tests do not support quantitative predictions. Okay, what do I mean by that? Let's delve into that a little bit more deeply. First, the relation between estimated beta and average historical return is much weaker than the CAPM suggests. Now note something here. The beta is telling us what the expected return should be. We can't observe expected returns on the market portfolio or individual assets. So if we're going to test the CAPM, we're going to have to use historical returns on individual stocks and historical returns of the market portfolio. That's really the only strategy we have for testing this. Okay? So the question is, does that relationship seem to hold? And the answer is, it doesn't really, because the relationship is much, much weaker than the CAPM tells us. And let me show you exactly what I mean by that. What I mean is that if this is the risk-free rate, and this is the return on the market portfolio, and the security market line should look like this, in fact, low beta stocks have higher expected returns than we would expect. Or I should say, low beta stocks have higher realized returns than we would expect, and high beta stocks have lower realized returns than we would expect. The security market line is too flat. Okay? And this is a problem, because in fact, in a lot of estimates of the CAPM, the security market line is almost flat. It's close to being flat. It's got a slope, but it's a very small slope. So what the heck is going on here? Beta doesn't seem to be capturing risk. Okay? Second, the market capitalization of a firm is a predictor of its average historical return even after accounting for beta. I want you to note that I'm actually talking about the market efficiency material now. I'm kind of integrating it into the discussion of the CAPM. We'll talk about that some more tomorrow, but this is actually in the chapter on market efficiency. I'm not going to hold you to details in that chapter above and beyond what we talked about in class. I think it's very interesting. I think it's very important. But I know I've thrown a lot of stuff at you guys, so I'm going to limit the coverage of that to what's in the slides. But this is an important point. Market capitalization or size of a firm is a predictor of its average historical return, even after accounting for data. Here's the point. If small stocks outperform large stocks on average, would you find that to be surprising? Not necessarily. You might say small stocks are riskier. Okay? Of course we'd expect small stocks to have higher average return. But if I told you that small stocks with a beta of 1.2 outperform large stocks with a beta of 1.2 now, that's surprising. That tells us that beta must not be capturing risk, okay? Or else there's something going on that we don't understand. Okay? So this is a challenge. This is a challenge to market efficiency, because it's very, very easy to beat the market just by buying small stocks. It's very easy to have a positive. What this is saying is that if you skew your portfolio towards smaller stocks, you can get a positive alpha. And I encountered portfolio managers that we hire for the foundation, for the foundations that I work for, engaging in these sorts of shenanigans all the time. Here's what they do. They claim that they are a large cap fund, but if you delve deeper into their portfolio, it actually turns out that they're holding a lot of mid-cap stocks, because that makes their performance look good relative to the performance of large-cap indices. Okay? Now, there's probably some risk going on there that explains this, because it's so easy to just buy smaller mid-cap funds. How could it be that easy to beat the market? Maybe our measure of risk and return is wrong. Okay? But the fact is that after accounting for beta, the size of a firm is a predictor of market performance. Okay? And this is a challenge to either the CAPM or market efficiency. Okay? And I think it's probably a challenge to the CAPM, because ultimately, it'd be so easy to exploit this to beat the market that I can't imagine that this has anything to do with market efficiency. Okay, stocks with low market-to-book ratios tend to have higher returns than stocks with high market-to-book ratios, again, after controlling for beta. What does this say? Okay, we take the book value of a firm, okay, and we have a firm which has a low market price of equity to book value of equity ratio. And those firms tend to have higher returns than stocks with high market price of equity to book value of equity after controlling for beta. Okay. Now, what could possibly explain this? Some people think that this may be explained by the fact that when companies do well, the price of the equity increases, but they oftentimes do too well, then is consistent with fundamentals, and then when the price reverses, their returns decline. Conversely, when stock prices have been beaten down and they're out of favor, ultimately they have market-beating returns as they come back into favor. That's a story that some people will tell you to try to explain this. The next violation of the CAPM. Stocks that have performed well over the past 6 months tend to have high expected returns over the following 6 months. This is called the momentum effect. And the momentum effect seems to be pretty powerful. Okay? Some people think that this has something to do with Apple's run up to over 700. Okay? What happened? People were piling in. And you see other people piling in. What do you do if you're a fund manager? Maybe you start to pile in as well. Okay? It could work in reverse as well, because momentum effects tend to eventually reverse. People were piling into emerging markets, and then everyone was trying to get out, and the price went down dramatically. But these momentum effects seem to have explanatory power that is not accounted for or consistent with the capital asset pricing model. Firms with high price earnings ratios have lower returns after controlling for beta. Okay, what is the price earnings ratio? It's the price that you pay per dollar's worth of earnings. The price that you pay, okay, the price per share relative to earnings per share. Let's say you have one company with a PE of 10, and you have another company with a PE of 20. Why in the world would you be willing to pay $20 for a dollar's worth of earnings with company B? Well, with company A, people would be only willing to buy, people would buy only, spend only $10 to get a dollar's worth of earnings. How can you possibly explain this difference? Yeah.
Because they think that the company's going to grow.
Okay, exactly. You might think that these earnings are going to grow faster for this company. Okay? If these earnings grow a lot faster than these earnings, because markets are forward-looking, they can justify paying more for this company. Okay? For that reason, companies with high PE ratios are oftentimes called what? They're called growth companies. And companies with low PE ratios are called value companies. Okay? And if you look at the style box we talked about when we talked about mutual funds are categorized in part on whether or not they tend to buy value stocks or growth stocks. Okay? Or a blend of the two. Okay? The style box that what you'll find in every prospectus looks like this. Okay? And we've got, I'm trying to remember which is on which axis. We could have a value, blend, growth, and large, mid-cap, and small for the sizes of the firms. So a large cap index fund, like the S&P 500, would fall in this box because it's a blend of value and growth stocks, and it's evaluated so that it, on average, is large stocks. Okay? So the historical record is that if over long periods of time you want to beat the market, you should buy and hold value-oriented funds that don't invest in a lot of these high-flying companies with high price earnings ratios. And if you do that, you're sure to miss the potential companies that turn out to be very, very profitable. But the thing to understand is those are really few and far between. The question is, how many dogs do you have to buy to get that diamond? Okay? And the value effect tells us that you have to buy too many dogs to find that diamond if you're simply buying a well-diversified portfolio of growth stocks. Okay? And then finally, stocks with high dividend yields have higher returns after controlling for beta. That's the key here. All of these violations of the CAPM are after controlling for beta. If the capital asset pricing model is valid, none of these effects should exist. But they all seem to exist. Okay? How many of you are just shocked to understand that this model that we spent so much time learning in intro has all these problems associated with it? Okay. The embarrassing fact is that in finance, which is essentially about risk and return, we don't have a good model of risk and return. Okay? Now, is that like a physicist saying that we don't understand the laws of gravity? Well, actually, the physicists don't understand the laws of gravity. Okay? And that's something that we're trying hard to understand. But physics is a lot simpler in a way, because physics is understanding laws of nature which are not time-varying. Think of how finance depends upon the behavior of people. Maybe the price earnings effect exists because you've got a lot of people that like positive skewness in their returns, and they're out there trying to, okay, positive skewness, that's a violation of the CAPM right there. If you like positive skewness, violation of the CAPM. Violation of the assumption of the CAPM. The CAPM assumes that people have mean variance preferences. They don't care about skewness. So it's very, very hard to model a world with people and where the institutions through which people interact are constantly changing. Where there are investing opportunities today which did not exist 10 years ago. You can buy an India ETF today. Okay, soon to be the most populous country in the world. You can buy an Indian ETF today. You could not 10 years ago. Okay. For this reason, if we were trying to figure out how how well a portfolio manager was doing if he or she were generating positive alpha. Using the CAPM would not be a very good way to do so if all it takes to beat the CAPM and generate positive alpha is to have put some mid-caps in your large cap portfolio and then get judged off the security market line. Okay? If that were all it took, I could teach you all in 15 minutes how to be a fund manager and generate positive alpha and look good to institutions and get hired for big bucks and make a fortune. Obviously, this is understood. So how can we judge portfolio performance recognizing that it would apparently be so easy to generate positive alpha in the context of a CAPM? Well, the Fama-French 3- and 4-factor models are widely used in assessing performance. And here's the idea, that rather than simply having the return be a function of the return on the market, we also have the return of a portfolio be a function of how well small companies did relative to large companies. This is small minus big. How well small companies did relative to large companies over in that particular time period. How high book-to-market firms did relative to low book-to-market firms in that time period. And then also sometimes they add a momentum effect here as well. And if you can generate positive alpha out of this sort of a framework, then that would suggest that in fact maybe you actually did have some stock picking ability. So it's going to be much more complicated when we recognize there are all these violations of the CAPM. You might say then, well, how's this? This is a model that actually explains returns pretty well. Does a good job, much better job of explaining returns than the capital asset pricing model. And if you take portfolio management, how many of you are planning to take that course? Okay. Hopefully, you'll estimate this sort of relationship and try to figure out if Fund A did better than a Fund B on a risk-adjusted basis. Okay? But the problem with this framework as a model of risk and return is it's totally ad hoc. And what I mean by ad hoc is that there's no theory for why high market-to-book firms should have different returns than low market-to-book returns firms. Or there's no reason why size should matter after we control for data. So this is simply an ad hoc way to describe what's going on in the world. So it's like we don't understand the laws of physics, but we've been able to estimate this equation, which you all learned when you took physics in high school, on the rate at which something falls. Okay? But if you don't understand how dark matter actually interacts with the matter we can observe, determine how light bends through time and all that stuff that we're just learning about in physics, then you really don't understand it. Okay? Okay, what are some of the potential explanations for the CAPM shortcomings? One is that various proxies for the market portfolio do not fully capture all of the relevant risk factors in the economy. Okay, what's an example? Human capital is excluded from proxies like the S&P 500 or VTI, which I gave you. Large firms may be perceived to be less vulnerable to the economic downturns that diminish the value of human capital. They therefore may command a lower risk premium. The idea is this: I am worried about losing my job, but I know I have to invest to have any chance of accumulating a retirement nest egg. I have to be in the market, but I'm worried. What do I do? Am I going to buy all these little companies that I've never heard of? Or am I going to buy companies like GE and Microsoft? And, well, maybe they look less risky. Maybe I'll buy the auto companies because I know I'll get bailed out if the companies go under. Or buy the big banks. Okay? Actually, they lost. The equity got wiped out. But that's a counterexample. Okay? Because big companies did have a lot of problems. but if we're looking at understanding what happened historically, maybe smaller companies look more risky if you're worried about how the evolution of the economy affects the value of your human capital. Look, your job prospects, when you graduate, are looking one heck of a lot better than they did 1 or 2 years ago. Why? Because you're studying so hard? No, even though you are, that's going to help you individually. But the reason why they're looking better is because the economy, the labor market is improving. There may be behavioral biases against classes of stock that have nothing to do with the marginal price of risk on those stocks. For example, portfolio managers don't lose their jobs for investing in Exxon, but they may if they invest in Ford when it's selling for $4 a share. Okay, Ford at $4 per share actually was a great buy. Okay, and Ford's doing real well now. In fact, Ford has outperformed the S&P 500 over the last year. Okay, but portfolio managers have to report what's in their portfolio periodically, and they may care about what shows up in their portfolio. In fact, there's a lot of evidence that portfolio managers engage in window dressing.